Welcome to the Deep Dive. Today, we are staring down, one of the most compelling paradoxes in modern tech finance, and it really centers on Oracle.
That's right. Oracle is now a really critical player in this whole AI cloud arms race. They're signing these truly historic, massive deals. We're talking about the biggest names in AI, like the creators of ChatGPT.
Right, deals often measured in the hundreds of billions of dollars in projected value.
Exactly.
So here's the question that really sent tremors through Wall Street. If Oracle is winning this AI arms race, securing these incredible compute contracts, why does it look like they are making, razor-thin profit margins on the exact deals that are supposed to define their future?
Yeah.
Our mission today is really to unpack the recent controversy. It was sparked by these internal reports about Oracle's gross margins, specifically on its NVIDIA-powered cloud server rental business.
And we're synthesizing quite a bit here. There are internal documents that seem to reveal the raw cost structure. We're tracking the market fallout that happened right after and analyzing the pretty pointed defense offered by the man who actually supplies the chips, NVIDIA CEO Jensen Huang.
Okay.
So this deep dive should give you a good sense of the true financial cost of building the AI infrastructure of tomorrow.
Let's start with that number, the financial data point that, had investors hitting the sell button pretty fast. So the revelation, it came from the information. They cited internal Oracle documents detailing the state of their NVIDIA cloud operation.
Right. And this business, it generated $900 million in sales in just 3 months, the period ending in August.
Which sounds great, right?
Yeah.
Huge revenue growth. That's the bull case.
It is huge growth. But then you look at the internal reports, and they put the gross margin on that $900 million at only 14%.
14%, wow.
Do the math. That's just $125 million in gross profit. And when you think about Oracle's reputation, legacy enterprise tech vendor, that figure is, frankly, shocking.
Shocking is maybe an understatement. I mean, when we look at Oracle's overall business, their company-wide gross margin is usually around 70%.
Yeah.
And if you go back into their history, the software business, those legacy margins were often 80% or even more, maybe just a decade ago. We're talking decades of really high purity profits.
And that's the contrast that caused the panic, Seeing a new core business stream, one that's super capital intensive and basically designed to replace that old high margin stream, come in at 14% it's a huge red flag.
Yeah.
To frame this for you, our sources point out that this 14% figure is actually lower than the average gross margins of many non-tech retail businesses, even low-cost ones.
So wait, we're looking at the foundational infrastructure for, the future of AI, the future of humanity maybe, being built on profit margins lower than a discount clothing retailer.
Seems like it, in the short term anyway.
That immediately shifts the strategic profile of the company, doesn't it?
It absolutely does. And the market reacted instantly. The day that report was published, Oracle stock fell, I think it was as much as 5% during the day.
Right, ended down about 2.5%.
Yeah, closed down 2.5%. Investors, they expect cloud companies to report margins maybe in the 30s or 40%.
Sure.
So the immediate implication here is that Oracle has maybe fundamentally changed its business model from high-margin software to low-margin, capital-intensive utility infrastructure.
But, okay, if the margins are so low, why are major investors still pouring money into Oracle? And why was the stock actually up, 36% earlier this year?
Right.
The answer has to lie in the explosive growth and just the sheer scale of the contracts they're signing.
Exactly. The growth figures are just colossal. You look at the remaining performance obligations, or RPO.
That's the backlog, right? Deals signed but not yet booked as revenue.
Precisely. It's not a forecast. It's hard, legally binding contract money. And that figure jumped a staggering 359% year over year in the first quarter of fiscal 2026.
359%. Okay, that kind of jump in legally binding contracts tells you they are definitely winning the current market race for these deals.
No question. And their ambitions reinforce this. Oracle forecasted hitting, get this, $144 billion in cloud infrastructure revenue by 2030.
Wow, $144 billion. That's an astronomical leap from just over $10 billion in 2025.
It is. And that leap, it seems to be underpinned by one massive customer in particular.
Okay.
A lot of this growth, especially that RPO increase, it's buoyed by a reported $300 billion compute deal with OpenAI.
The ChatGPT creators again?
Yep, tied directly to their Stargate project, which apparently involves opening 5 huge data centers just packed, completely packed with newest NVIDIA chips.
So it's a huge bet on the biggest AI player out there right now.
massive bet.
And this growth potential, this massive scale, it's precisely why NVIDIA's CEO Jensen Huang actually stepped in publicly to defend Oracle's strategy when the margin news hit.
It did. He provided the long game argument. Oh, Huang, I mean, he understands the physics of building this infrastructure,
Yeah,
right?
you think so, yeah.
He argued that this short-term margin pressure, it's expected when you're launching brand new technology at this kind of scale. His key quote was something like, well, Oracle might not make money in the beginning, they will be wonderfully profitable over the life of the system.
Okay, so it's an amortization argument, basically. Spread the cost.
Pretty much. And he also zeroed in on the complexity. He was explicit. Operating these massive systems is not easy.
Mm-hmm.
They are giant supercomputers. They require immense specialized operation. You need land, reliable power, complex cooling systems.
Right, all the infrastructure stuff?
He's essentially saying, look, you can't expect the gross margin of a finished software product when you're still literally laying the concrete foundation for a global utility. And that operational reality that Wang talked about, it brings us right back to the concrete costs that are forcing that margin down to 14%.
Okay.
When we look at those internal documents again, we can sort of trace exactly where the money is draining away.
So the fundamental cost challenge, it sounds like, is just the high price tag on the raw materials, those NVIDIA GPUs. What specifically makes the cost of those chips and, the necessary networking gear so fundamentally different from Oracle's traditional server purchases?
Well, it's the sheer complexity and the scale involved. I mean, these aren't your standard general-purpose CPUs.
Right.
They're specialized parallel processors. Each one costs tens of thousands of dollars, and they have to be linked together via specialized, super low-latency networking systems that cost thousands more per connection.
Okay.
Plus, the power draw and the cooling requirements are just exponential compared to legacy cloud servers. It's a whole different beast.
And crucially, the sources we looked at note that to win these huge multi-billion-dollar contracts, especially with players like OpenAI and Meta cloud providers, Oracle included, have had to offer, quote, hefty discounts on the rental prices.
Yep, compared to their standard list rates.
So winning market share basically meant trading away immediate profitability. Is that the idea?
Absolutely. Analysts like John DiFucci and Derek Luria, they point this out. It's a strategic choice. Accept the discounting now to gain access to the fastest growing market segment out there.
Okay, now let's talk about the specific accounting for a second. When we dissect that 14% gross margin number, we know it includes things like labor, power, and some depreciation.
Right.
But the internal documents revealed this fascinating and maybe concerning detail, that unspecified depreciation expenses could eat up another 7 percentage points of margin.
Yeah, that's a big potential hidden cost. It's complex, but really crucial.
Explain that a bit more. What does unspecified depreciation signal here?
Well, when a company reports a gross margin, it's supposed to reflect the direct cost of goods sold. When they mention unspecified depreciation, it raises questions about how Oracle is choosing to recognize the expense of this rapidly, let's say, obsolescing AI hardware.
Meaning, are they spreading the cost out too long?
Potentially. Are they amortizing the cost of these incredibly expensive chips over, say, 5 years, when everyone kind of knows they'll be functionally replaced by a better, faster model in maybe 2 years? If those costs were fully loaded immediately, recognized much faster, the real margin might be way lower, maybe even low single digits.
So, in essence, the 14% figure itself might be partly a result of, let's say, short-term accounting choices that paint a slightly rosier picture than the true fully loaded cost of acquiring and running this bleeding-edge AI hardware.
Precisely. And you can see the immediate impact when they actually install the newest tech. The documents show Oracle lost nearly $100 million just from rentals of NVIDIA's newest Blackwell chips in the most recent quarter.
$100 million loss on the newest chips.
Wow. The newest, fastest technology is literally bleeding cash right now for them.
And that's reflected in the margins for those specific installations.
Yeah, the reports indicate margins dip sharply, sometimes from over 20% down to the low teens whenever they installed newer NVIDIA chips, like in those key facilities, the ones dedicated to OpenAI down in Abilene, Texas.
Okay. And there's one more piece here. Their infrastructure strategy is a bit different, isn't it?
It is. Oracle is different from its big rivals, AWS, Google Cloud, because it primarily leases data centers from third parties, like a company called Crusoe.
Right. I remember Safra Katz, the executive vice chair, commenting that owning property is not really our specialty.
Exactly.
So what's the strategic trade-off there? Leasing versus owning in this high-stakes AI arms race?
Well, leasing means lower upfront capital expenditure, right? Which is key when you're already planning to invest, $35 billion elsewhere in chips and other infrastructure this year.
Saves cash up front.
But the downside is it can lead to potentially higher long-term operational costs. And crucially, maybe less control over the physical environment, things like power security, and getting those really bespoke cooling solutions that these supercomputers need.
Gotcha.
So it's a way to grow really fast without taking on massive real estate debt. But it might squeeze operating expenses down the line.
Okay, so this clash between massive growth, massive spending, and these, minuscule margins leads us straight to the great split decision on Wall Street. Is this a genius long-term play by Oracle, or is it a desperate, maybe margin-destroying financial pivot?
Yeah, the perspectives are really divided. The bearish view, it's anchored by fear, basically.
Fear of what exactly?
They look at the massive capital expenditures projected to be $35 billion this fiscal year alone, which has led to negative free cash flow recently.
Not something investors usually like to see.
Not at all. And their biggest worry is this. If this low-margin GPU rental revenue starts to eclipse their traditional high-margin software revenue, which, let's face it, it's kind of designed to do eventually,
Right.
then the overall corporate margin profile will plummet.
Right, dropping from that historical 70% level to something much, much lower.
Which would fundamentally change Oracle's valuation profile. They wouldn't really be seen as a software giant anymore. They'd be valued more like a capital-intensive utility company.
Okay, that's the bear case. What about the bulls?
Well, the bullish camp, and you see analysts like Mizuho making this argument, they say this pain is temporary. They believe these margins are low because Oracle is in this rapid build-out phase. It's the cost of entry.
So they expect improvement.
Yeah, they argue that as Oracle achieves scale, those classic scale efficiencies will kick in. Server utilization will hit 95%, power costs will be negotiated down over time, supply chain gets optimized.
And margins will rise naturally.
That's the bet. They think margins will naturally improve, making the recent stock sell-off a classic buying opportunity for the long term.
Okay, but regardless of whether the margins eventually recover or not, the company is facing a pretty critical vulnerability that the sources highlight: customer concentration risk.
Oh yeah, this is perhaps the most precarious factor in the whole story.
How concentrated are we talking?
Oracle's top 5 AI cloud customers. The list includes ByteDance, Meta, xAI, OpenAI, and interestingly, NVIDIA itself apparently make up roughly 80% of this entire new AI cloud business.
80% from just 5 customers. Wow, think about that. The entire strategic pivot of this massive company rests on the fortunes and decisions of just 5 companies.
It gets even tighter than that, actually. According to the reports, virtually all of the $317 billion worth of cloud deals signed in that quarter ending in August came from just one customer, OpenAI.
All of it from OpenAI.
Virtually all of it in that specific massive RPO jump.
That is an enormous reliance on the continued success and the continued loyalty of a single customer. That's a huge risk factor.
It's the ultimate strategic gamble, isn't it? As analysts summarized it, Oracle basically faced a choice. They could have tried to maintain their high historical margins and probably missed out entirely on these huge high-growth AI contracts. Or they could accept these lower, incremental profits right now, grab critical market share while the land grab is happening, and try to position themselves as absolutely indispensable to the future of AI.
And they clearly chose market share and scale over short-term margins.
They absolutely did. Hashtag tag outro.
So, what does this aggressive strategic shift really mean for you, the listener, trying to make sense of the AI landscape?
I think the central takeaway is that Oracle is fundamentally changing its identity.
Yeah, it really is. They're transitioning from being that classic, highly profitable software business we all knew,
Right.
to becoming a capital-intensive, high-growth, but at least for the near term, low-margin infrastructure provider in the global AI race.
They're basically paying the hefty cost of entry for the next generation of computing.
Exactly. And the next few years will be a real test of patience, scale, and crucially, execution, to see if they can actually escape the gravitational pull of these low margins.
And this brings us to maybe the final provocative observation that was kind of hidden within those internal documents, the bits about profitability. We noted earlier that the newest chips, the Blackwells, are actually losing money for Oracle right now.
Yeah, bleeding cash.
But the documents also seem to reveal that older generation chips, specifically the Ampere chips from back in 2020, appear to be helping Oracle's margins. They're contributing positively.
That's fascinating. It suggests that Oracle's current, albeit thin, profitability is heavily reliant on hardware that has already gone through significant depreciation.
Right, the cost has been written down over time.
Yeah, so that older depreciated hardware is effectively offsetting the high cost of the new builds and maybe cushioning the blow from the massive discounts they're offering to win those big deals.
Which seems to directly contradict what Jensen Huang said. Right. His assertion that the release of newer chips basically wipes out demand for older ones.
It does seem to contradict that, or at least complicate it significantly. The fact that these older chips are apparently propping up that 14% margin figure is pretty startling when you think about it. So the unanswered strategic question for Oracle, and really for all of us watching this AI infrastructure arms race, is this. If the only clear path to profitability right now relies on using heavily depreciated older hardware and offering aggressive discounts to win deals.
Yeah, what's the long-term plan?
Exactly. What fundamental changes, whether that means successfully instituting future price hikes or achieving efficiency gains far beyond what their competitors can manage, or maybe securing truly massive exclusive energy deals, what must Oracle execute to make the next generation of AI compute truly sustainably profitable on its own terms?
That really is the multi-billion-dollar strategic question for the next 5 years, isn't it?
It certainly is.
Well, we appreciate you diving deep with us today on this one.